Warning: this video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all.
Alright, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. Today, we are going to be running through the base case hypothesis for the channel. As always, I like to come back once a week and check in and make sure things are still going according to plan so that I can have continued confidence in my posturing and in my positioning, whilst simultaneously checking for invalidations. If things start to go against my expectations, then I want to know immediately so that I can start to make any necessary adjustments. Because ultimately, all I really care about is staying on the right side of the trade. So from the top, for the stock market, we were expecting a big blow-off top to all-time highs, to see rate cuts somewhere around the top, and then to enter a bear market and a global recession. And the key here is that during this recession, there would be a deflationary component. I continue to look at things like the longer-term cycles. This one, for example, is a 17-year cycle measured top to top in the stock market. These are 12-month candles, and this suggests that we will continue to see a top put in sometime this year. And what's most interesting to me is that if indeed we do see a top this year, or perhaps as late as early next year, that top, those highs for the stock market could remain the highs for up to a decade as we experience one of these lost decades that we've seen multiple times before whilst the stochastic oscillator resets itself. You can see at the hard right edge showing currently all the familiar symptoms of an oscillator reset. Does not mean it couldn't be undone and curl back up, but until such time as the market proves that to me, then I continue to stand with this as the base case. Fast forward to today and we can see the stock market is very much operating within the realm of expectation. We have, of course, already seen a 50 basis point rate cut from the Fed at the last FOMC. And so for me, all that is left to unfold here is perhaps a couple more months of upside on this third angle before ultimately a breakdown. And it is on that breakdown that I will be officially declaring tops. I will be officially flipping to net short and expecting a whole heap of bear market and recession to follow over the coming months. For Bitcoin, the idea was pretty simple. The idea was that we would top much sooner than all prior cycles have shown us, that we would make an all-time high before the halving, and here's the key part, that we would have to spend significantly more than the 12 months in a bear market decline that we are used to seeing for Bitcoin. This hypothesis of mine was half correct. It did successfully call an all-time high before the halving. However, it is in this neighborhood that the one component that has not quite played ball for me during this whole base case hypothesis is that I was not expecting to spend 6 months consolidating in here like we have done. As I just said, I was not expecting us to spend so much time in here. However, I do still believe there is scope for one final push in this fifth wave before ultimately we violate this big parabolic blow off top to the downside alongside that stock market violating its parabolic blow off top. And I really like this Elliott wave count here from Tony the Bull that shows 1, 2, 3, 4 with a throw under of the channel before we should expect an extended fifth wave, including a throw over as per the schematic down here. So I'm not quite yet ready to discount the idea that Bitcoin has one final squeeze to new all-time highs ahead of it. However, objectively speaking, as I said, this has been a much longer consolidation than I was expecting initially. In terms of the macro, I've been long suggesting that anything you do to the M2 rate of change shows up in the CPI, albeit with a bit of a lag. We did see this down, sideways wobble and down in the M2 rate of change, which has corresponded to down, sideways, and here's the important part, down, given the last CPI print came in at 2.5%. We've also seen PCE data come out in the last couple of weeks, which was further supportive of this idea. And during this sideways wobble that we had seen, many investors were making the case that inflation was sticky and that 1970s overlay was going to come to fruition. Therefore, we were going to see another upside push for inflation. But I have long been making the case that the Fed is actually far later to cut than it should have been. The Fed is very far behind the inflation curve, and thus the real risk here is not only continuation of disinflation, but ultimately a short period of asset price deflation. We have CPI coming up in the following week, so it's going to be really interesting to see if we continue to see CPI come off much faster than most investors are currently anticipating. And Trueflation is showing us this, because the Trueflation data currently sits just below 2%. I think any kind of move below the prior readout of 2.5% for the government official reported rate will indeed alert the market to just how far behind the curve the Fed is with its cutting cycle. Another major component of this hypothesis was if indeed we're going to have a bear market and a global recession and even have a short period of asset price deflation, wouldn't we therefore expect to see labour market deterioration? And of course, right on schedule, we continue to see labour market deterioration. We have had initial jobless claims coming in hotter than expected. Jobless claims 1 year MA has been crossing above the 3-year moving average. So again, synonymous with recessions. We also continue to see job job cut announcements skyrocketing to the second highest level in 13 years. We continue to see the labour market deteriorate in real time in front of our eyes, not the kind of thing you would expect to see if a recession threat wasn't just around the corner. And keep in mind, typically in an expanding economy and bull market, you'd see private hiring trending up. However, today we have the exact opposite, trending down. Again, another sign that a recession is closer than a lot of people are willing to entertain. So we also saw on Friday the unemployment rate come out, and it came in at 4.1%. And I saw a lot of people championing this, saying, there we go, we've avoided a recession, soft landing. And whilst that's true for now, okay, as ever, the details are what matter. What we actually saw was the biggest monthly spike in government workers on record, which makes the difference between a 4.1%, which is what was reported in the unemployment rate for the US, versus what would have been 4.5% unemployment rate. Does anyone actually believe this number? If you go through the comments to this post, all of them are like, no, this is complete BS, right? People have just had enough because they continuously release this unemployment data and then quietly revise it down a couple of weeks later. Consensus was that 150k jobs would be added, and what we saw reported was 254,000 jobs reported. So massive difference here. But when you dig into the details, before adjustments, the private sector shed 458,000 jobs in September, but government employment, on the other hand, jumped by an unadjusted 918,000. Whilst investors will continue to look right beneath their noses, take the data at face value, I think for those of us that are willing to put in the work, dig a little bit deeper, we can see that under the hood, okay, things are not quite as they seem. I continue to make the case that the labour market is deteriorating and that the alarm bells for me are ringing because they consistently keep manipulating this data and trying to make it look less severe than it actually is. And to visualize the unemployment here, you can see curling up and starting to accelerate just like it did in all prior times that we saw a recession. And here's the key part, this is also occurring on an inverted yield curve that has now normalized and reverted back above the zero line. All prior instances we saw this led to a recession in the not too distant future. And whilst the government has a current projected unemployment rate that looks something akin to this, up until 2026. They also, back in 2007, remember, projected something akin to this. And what we saw instead was a large spike to the upside. And again, I suggest to you, we are indeed going to get a large spike to the upside. Many investors will be more than happy with 4.1%, but for me, 4.5% says that this thing is still going in the direction I expect it to go. And like I said, I'm not really sure how I feel about the government just adding 1 million jobs to offset the fact that we lost 500,000 in the private sector. But again, I'll leave that up to you. Thus, I continue to stand by the base case hypothesis that we are indeed at the end of these longer term cycles. We are indeed putting in this parabolic blow off top. And eventually when this thing breaks down, we will be moving into a bear market and a global recession with unemployment rising, with inflation dropping like a stone before ultimately slipping into a short period of asset price deflation. And I've been making the case over and over again that when we look back at many of these recession indicators that have been flashing, when we look back at the rate of unemployment deterioration, when we look back at how far behind the curve, the inflation curve, the Fed was, all of this will actually be pretty obvious in hindsight. We have also been tracking this Sahm Recession Rule indicator, which has officially flashed above the 0.5 threshold required to trigger a recession. What's really interesting about this is this upcoming week, we will get another print. It will be interesting for me to see if this continues to move to the upside, synonymous again with seeing recessionary periods. If you're in the camp of people that thinks we can avoid a recession, then you really need to see this thing turned down by next weekend's deep dive. One saving grace for the people that think we can avoid a recession came in the form of this ISM manufacturing services data, which came in hot, okay, significantly above the prior readout and the forecast, indicative of economic expansion. So this is one thing you do have in your favor if you think we can indeed engineer a soft landing. But as always, the devil is in the details. I absolutely have been calling and predicting that as we get to these blow off top angles, as we start to get into these third and final ascending angles in the risk assets, we will see the soft landing narrative proliferate. I showed in the last weekend's deep dive that it's all throughout the mainstream media that we are probably going to get to see a soft landing. We also saw the Treasury Secretary, Yellen, come out and say that her base case is a soft landing. And again, we can look at the Wall Street analysts and see that around 90% of them have no landing or soft landing as their base case. So therefore, currently calling for a recession is quite a highly contrarian trade, despite all of the fear-mongering and doomsaying out there. But once again, I respectfully ask you, don't tar me with that fear-monger, doomsayer, recession caller brush, because I have been long and strong in trading this thing publicly the entire way up, and we are now getting to the end of this parabolic blow off top. where if the second half of this is going to come to fruition like I expect it to, we should start to see this stock market roll over and break down by the end of the year. We've also got another macro chart here suggesting recession is inevitable because the ratio just crossed above its 4-year cycle moving average for the industrial production divided by the unemployment rate. And you can see every other time we saw this, it led to recessionary periods. Once again, I make the argument that if we come back in a few months' time and something like this is unfolded, it will all be pretty obvious in hindsight. The high yield credit spreads are currently not signaling a recession or a stressed financial condition set is upon us. You can see down here, okay, we are compressing, so no sign of danger just yet. But the more we compress, the more likely it is, in my opinion, that we are going to get an explosive upside move. And you can see here, okay, typical and to be expected of financially stressed conditions and recessionary periods. So I don't think it's going to be a very long time before we do see a breakout here. And when we do, alarm bells should be ringing. If I scroll this thing back to 2008, you can also see the thing breaks out as we move into those recessionary periods. One last thing I wanted to point out was that after the unemployment rate came out and is seemingly not recessionary, we saw the CME has repriced rates in favor of a 25 basis point cut in November's meeting, up to 97.4%, with the remaining 2.5% pricing in we will be paused in November. We also saw the bond market trying to price this, okay, as the yields moved higher, but I still make the case that this is probably just a counter trend bounce that will reject a resistance and roll over. Now, invalidation is a breakout here and a repair. Then we can say, okay, something else is going on. We probably have avoided a recession. We probably have got a soft landing, and we actually don't have to worry about recessions at all. But I do think we should be watching this because rejection here and a rollover will be the bond market continuing to tell the Fed that it is behind the curve. It does need to cut more than the 25 basis points that's currently being priced. And I would suggest to you that we keep a very close eye on the CPI data this week. If the CPI data comes in cold like I expect it to, if it continues to move in the direction of disinflation, then I think this will reveal once more just how far behind the curve the Fed is, and we will most probably see these rates significantly repriced towards 50 basis points. And one of the biggest issues I have here, if we draw our eyes to this chart, okay, is we are in a third angle. We are in a blow off top angle. I do for sure expect to see me continue to add to longs here. I've been trading in and out of this thing the whole way up. I continue to expect me to add longs this week and catch the final leg to the upside. But when we zoom out, okay, investors are getting incredibly confident here that there's no recession and that everything under the hood is fine, right as the stock market is going parabolic. This is not my first rodeo. I have traded many different blow-off tops in many different asset classes, and that is why the more vertical we go, the more I know that it is near certain we are going to violate this spectacularly to the downside. The first angle becomes the minimum target, and all of this is occurring against a sea of new investors that have been in the market less than 3 or 4 years, all 100% sure of themselves that we're never going to have a recession. I'm seeing people throw terms around like the Fed can't afford a recession, and this is just absolute nonsense, okay? We're in a blow-off top, which has been expected and predicted since the lows. When we zoom out and look at it, this looks almost complete to me. And again, I don't know why people are so sure of themselves that this can continue forever. Let me assure you it cannot. And also, it is incredibly rare to see this third angle violate and then the second angle continue as the primary trend. Okay, normally once we get the third angle violation, we bounce up here and then we break down shortly thereafter. And like I said a million times, the first angle becomes the minimum target. I reckon this time around we're going to break down, retest, and resume off of that first angle. So I know there's a lot of newer investors here that throw around terms and we can never have a recession and everyone's sick to death of people calling for recessions, but no matter what the macro data is, no matter how much you want to pay attention to it, look at the chart. The charts are going parabolic, okay? This is not sustainable. And every other time in history that we see a parabolic blow off top at the end of those multi-decade cycles, no less, okay, these things do break down spectacularly to the downside. So I am still long and strong, make no mistake about it. I'm still going to be adding positions this week, but the longer this thing goes up, okay, the more twitchy and nervous I become, the more certain I become that we are going to violate this thing spectacularly to the downside. And notice the sentiment out there is becoming incredibly one-sided, okay? Recession callers, people that are calling for a blow-off top and a breakdown are getting mocked and jeered. And again, all of that stuff, especially if you've been following me for a long time, was predicted all the way back here. We knew that by the time we got into the third angle, people would be insufferable. You'd be mocked and ridiculed for suggesting a recession is around the corner. But the only thing that hasn't gone perfectly according to plan is Bitcoin. Bitcoin is the only thing that didn't play out exactly as expected. We got 3 angles in the stock market. We got rate cuts to occur right around that third angle. We got inflation to come down when everybody thought it was sticky. We got the bond market to sell off and force the Fed to do cuts at the last FOMC meeting. We are seeing labor market deterioration and we're seeing the Fed try to cover it up. We are seeing bankruptcies skyrocket. We're seeing the consumer get wrecked. We're seeing a whole heap of new investors that are very, very sure of themselves move into the markets and throw their opinions around as if they have some right to do so, when quite literally all we need to see is Bitcoin spend a little less time consolidating and a little more time moving up towards a top at the end of this year or very early next year, and we'll be able to tick this entire thing off and say everything went perfectly according to expectations. Once again, I suggest to you, if you're super confident here, then you zoom out and draw 3 angles and then go back and find other instances of when you could draw 3 angles and then see how many of those times we managed to continue going up only forever. Okay, that is not how these markets work. That is not how these parabolic structures work. The higher up we go here, the more explosive and the more vertical it gets, the more twitchy and nervous you should be getting, particularly because this is occurring at the end of those multi-decade cycles. I'll link a video at the end of this video called something along the lines of mind-blowing cycle analysis that shows you that all of these longer term cycles are due to top in November or December. So once again, we're going parabolic, we're going near vertical in the stock market right at the time when these multi-decade cycles are due to top sometime in the next 2 months. Don't get it twisted. I'm still long and strong. I'm still looking to add positions. I will still be notifying level 3 members in the members section of the exact levels and when I pull the trigger. But this third angle is not sustainable. We cannot keep going vertical like this for weeks and weeks and weeks on end. We've already spent something like 5 weeks. Anyone that knows anything about third angles knows they last between 2 and 8 weeks on average. A really hyper-extended third angle can last as much as 12 weeks. So yes, long and strong, yes, profits are nice, but for me, I'm getting incredibly twitchy and nervous up here because I know what comes next because this is not my first rodeo. With that said, I will also be looking to add a NASDAQ long this week to catch that final move up towards what I believe will be 22 or 23k. I'm also going to be looking to see if the Dow is going to continue to push, and if so, we'll call this as the low. We'll put the stop just below the low, and we'll look to take this thing to 44k, allowing the profit from the first trades to finance the risk on the second trades. We do have to keep an open mind to seeing one final undercut to a new low Monday or Tuesday, but if that doesn't come, then we can confirm this is the cycle low and we are indeed moving up. If that's the case, I should point out, okay, notice we didn't even get a touch of the third angle. This is very, very, very blow off top in characteristic. The fact we didn't even get a touch at support shows buyers are willing to just jump in and buy stuff hand over fist here. Okay, this is exactly what you'd expect to see as the soft landing narrative continues to proliferate. The Russell 2K also looking to move into expansion. Finally, we've had a long-term target of 2,700 since the long at the lows. The stop has moved up, so we can't possibly lose here. Notice how gold, to me, looks like it wants one final undercut. But if not, if it's going to break out and push here, then again, we'll call the cycle low and we'll get long with a stop just below the low. Although I do think it's probably prudent here to be open to seeing a dip Monday and Tuesday. And Bitcoin continues to do Bitcoin things, right? I've been saying over and over again, there's a whole sea of people that seem to think they're going to be able to get one set of bids filled somewhere in this neighborhood, okay? And then from there, we can just shoot straight to all-time highs. I really don't think we're going to get that. It's not really what the cycles suggest to me. I think we're right around that window to see some kind of half-cycle low come out of here, and then we should be looking for a new push to all-time highs, a very explosive run to around 100k plus. And again, note that a whole heap of new investors that bought Bitcoin for the first time here at 73k are now 100% sure of themselves that this thing cannot possibly go to 100k in just a matter of weeks. But once again, I suggest to you, go back and study third angles, look at how long they last, look at how much ground they cover in that time. These third and final angles typically last somewhere between 2 and 12 weeks at the most. 2 and 8 weeks is far more typical. And we've already spent 5 weeks in the stock market's third and final angle. So I think alarm bells should be ringing here. Again, though, I am long and strong here. I'm even looking to add if we can get a breakout above this downward slip in red at the top. And if you're a level 3 member, we're going to be continuing to add those crypto-related equities and miners to catch even more gains. So a wild time to be alive, okay? So far, I still sit here and say I'm pretty confident that things are going according to plan. We'll need to see the CPI data this week and make sure that comes in cold. As these third and final angles continue to get more and more insane, I fully expect people to become more and more insufferable. I expect to see a whole heap of screenshots of profits online, and all of that will simply be a marker that we are about to ruin most people's financial or trading or investing careers. As I often say, it's always good to stay humble and keep in mind most people have a career expectancy of just 3 years. Most people will not survive for more than 3 years. And many of these influencers that you think are good at their job at the moment will be disappearing over the next couple of years because they will not survive the recession themselves. I have seen a whole heap of these people that proved to me that they weren't real traders, that they could not manage risk just on the yen carry trade unwind. And I'm telling you now, a whole heap of these traders are going to get wiped out and they're going to disappear forever and leave a bunch of people wondering how they ever trusted these people in the first place. So again, just stay humble, okay? We can stay long and strong until the chart gives us reason not to, but keep in mind, like I've said a million times, but it's super super important. We are in the near vertical third and final blow off top angles. Bitcoin will likely be in it within a number of weeks. Historically speaking, we do not stay in those third and final angles very long. So the higher up we go, the more I'm going to be starting to think this thing is going to come tumbling down in a spectacular fashion, as is extremely typical for blow-off tops and third angle violations. If you're new here, make sure you subscribe to see me get underneath some cycle lows in the next couple of sessions. We'll be probably long and strong across the board and adding to positions by Tuesday or Wednesday at the absolute latest. If you're a level 3 member, look out for the members only video I'm going to be putting out for you guys. We're going to do a deep dive and cover all those crypto related equities, and I can see myself adding a whole heap of exposure in the level 3 members section this week as well. For everyone else, I hope you're doing well in life. I hope you have a fantastic weekend, and until next time, take care from me. All the best. Cheers. Bye.